Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feeds for updates. Okay, so we got ourselves a bit of a rough morning going on in the overall market. I went to a CMT Association meeting on Wednesday, and one of the things they had at the meeting, the gentleman had put up a tool that some CFAs, certified financial analysts, had put together, or chartered financial analysts had put together for a recession watch. And I thought it was interesting because they didn't use a lot of the things that I would use. So we're going to cover that off today. And I'm going to cover off a little bit about what's going on with the Bank of Japan and why I think that plays out in 2019, maybe 2020. Again, let's not try to pick it to the day, but it just keeps getting more and more interesting. So here's Germany, and Germany had a pretty weak ISM number overnight, and there was some consternation about that, and we'll talk about that on the charts. So let's get into it. First of all, where are we? This is a 1 hour chart updating every 5 seconds. You can get that with the Pro tool. And what you see is we're breaking above the 20 period moving average on the VIX for the first time in a while. Here's the S&P 60 minute. And again, we've got this uptrend. And we had the meeting on the Fed meeting on Wednesday, and basically haven't made any progress since then. And I thought it might be last Friday, the quantitative easing that kind of topped us out. And so, whatever, close enough for me. We finished, we finished in around here, so call it 28.25, and here we are back to test that level again. MACD gently sloping down, making lower highs, lower lows. That doesn't give me any confidence. And then here's the Russell, and again, it's having trouble staying above its 20-day moving average, and it looks like it's going to start to make new 2-week lows if it gets any lower today. TSX is barely above its 20-month or 20-day moving average. This is the 100 period on the 60-minute chart, which works out to roughly the 20 period on the daily chart. And then natural gas dropped quickly this morning. Oil dropped quickly. Gold popped slightly, still inside the range it's been in for the last couple of days. And bonds took off. No surprise there. We're going to cover that a little bit. And the US dollar starting to rise up again. So Fed meeting was the turn date so far. And that doesn't surprise me. So, and if you haven't seen my chart with the Fed meeting dates and the US dollar in the background, I cover that off on weekends. So you're more than welcome to watch the weekly market review to catch up on that chart. So first of all, this is the chart for Germany today. And this is the EWG. This chart is an ETF that tracks Germany, but it tracks it in US dollars. That's not a big deal, but I can show you the hedged version here in a little bit. I'm just going to hit this zoom thumbnail. What that's going to do is give me this little box on the side so we can see what's going on. So it's still making a higher high and a higher low. Again, when the German market closes today, we'll see if it can hold that low. It's a pretty important place on the chart. You can see we're trapped between the 10-week and the 40-week moving averages. If I was expecting the market to fail, usually it's around the 40-week. Pretty safe to say this is an important test. Histogram on momentum is starting to roll over. PPO is below zero. This is textbook how markets top. So not very happy to see that pattern play out. One of the things I do want to talk about, let's just go look at the HEWG and see what the difference might be. And on that one, same issue. So we briefly got above. So this is more like the DAX exactly. It doesn't have the effect of the US dollar in it. And you can see we've been rising up here, and right now we're stuck at this, or sitting at this resistance level where we've been traveling around for almost 4 weeks. And it looks like we're going to be back to the same sorts of levels. In terms of volume, still seeing better volume a couple of weeks ago, but really nothing since then. So that kind of lays it out. Now, I do want to talk specifically about the Nikkei, and this is really big picture stuff, and then we'll get into the Recession Watch. But I printed off a couple of articles, and one of the articles was Bank of Japan runs out of options on the eve of the Xi and Trump meeting. And what happened here was, this was back in November, and they were talking about how the Bank of Japan is running out of monetary easing policy. And then in December, this was mid-December, and the market had topped. Stock market was dropping, and they were talking about how the Bank of Japan ETF buying hits yearly record. And then March 13th, there was an article how, as Japanese stocks stabilize, the Bank of Japan's ETF buying is at the lowest level since 2016. Well, what makes that quite bizarre is each day, so you can literally go get an Excel spreadsheet of what the Bank of Japan is doing every day and when they're buying. And on this spreadsheet, what it shows here is every day the Bank of Japan goes in and buys 1.2 billion yen worth of ETFs. And on certain days, they buy more, other than those mentioned in column 2. And every now and then they buy some REITs. So you can get this printout. Well, I decided to just go back and map it. And what you find is, so here's 4 days, the 3rd, the 7th, the 8th, and the 13th of this month. So here's the 3rd, the 7th, the 8th, and the 13th of this month. So all on down days, they try to buy and hold the market up. So here we are in December, and you can see December was a tough month for markets around the world. Well, the Bank of Japan was literally buying almost every day just to try and hold things together. And then in January here, they were buying even on the way up while the market was bouncing off the lows. And then we got to February, and again, they only had to buy 3 times in February, so it's a short month. The point I want to make is, this is real world. This isn't the monopoly game we're in, but the Fed is literally in Japan trying to buy on every down dip to hold the market up. And so if that doesn't scare you, nothing will. But in December, it didn't change the shape of the charts or whatever. Their charts were the same as our charts. So I went back, and from this ClearBridge document that we're going to cover here in a little bit, they have a Recession Watch, and what they did here on this Recession Watch was they mapped out all these dates. So I'm going to take these dates and just put them on the Nikkei chart for you. And what we see here over time was that all of these recessions also showed up in Japan as pretty meaningful dips. And most recessions started after a long uptrend, and when the trend line broke, that was a pretty good clue. Okay, the exception to that would be in the top in 2000. Apparently, the U.S. market didn't enter recession until 2001. I didn't go try to pick up the dates on the specific recession drawbacks. I just used the dates they gave me. But looking at this chart, and we can obviously shorten up this timeline here. Let's just go pick the last 40 years. The point I want to make is when these charts break, these big long trend lines, it's not a bad place to at least be aware of the risk. And I took a couple of different measures. I took the PPO. And when the PPO is below 0, now for Japan, it's been below 0 a lot more than it has been for America. And what we see on this is, these big pullbacks have happened during recessions, which was fine. But more importantly was, there were other meaningful pullbacks that weren't actually caused by a recession. So when we see these other pullbacks, this was a pretty meaningful one for them here and in here. And so far, the U.S. market was almost straight up during that period. So it was having pullbacks, but it was still ascending while the Japanese market was essentially going sideways. My point here is the Japanese market briefly in 2015 broke a trend line, then pulled back, and then rallied up again and is trying to take out these prior highs. And again, you have a Japanese central bank with a foot on the gas pedal, and right now they own over 80% of the ETFs in Japan. And every month they're on pace to pick it up a little bit more. So I think by, if they just kind of kept the typical level of spending going, by the end of 2020, they would own all the ETFs in Japan. So at some point, I don't think this ends well, and they'll figure out something else to buy to hold to glue it together. But in the meantime, it wouldn't surprise me that some of these breaks are starting. Some of these cracks are starting to appear. And so on this chart here, we can just shrink it down to the last 10 years, and that's going to give us this period from the 09 recession. And in here, the point I want to make is we're living below the 40-week moving average after staying above it for much of the trip. Back here in 2012, we had the same thing where the market was trending up, staying pretty well above the 40-week moving average. Bounced into it here, failed, and then rallied out of it, and then stayed above it for the most part all the way to last quarter or last fall. And then in October, we started to drop below, and now we're still below the 40-week moving average. I think Japan's a big influence, and their stock market tracks pretty well based on the chart you just saw. And in the US market, what we saw was a crack back here in 2015. It took until May for the market to top out, and then it rolled over. Once you were below the 40-week, it was a good place to be cautious. We've rallied up, and we're above it, and that is important. I think what's also important, though, is that Germany and Japan are both still below their 40-week moving average, and it would be an important place for us to watch to see if this global weakness is going to start to turn things down. And one of the things that Kuroda talks about is that the uncertainty of global trade was causing some consternation for the Bank of Japan. And so I don't think you want to wait until everything slows down to figure out that there was uncertainty over global trade. I think you want to watch the price action. Okay, so with that, before we get into the actual recession watch, I'm going to, we've got a quick break for you. StockCharts is celebrating its 20th anniversary in April, and so we've got a little story for you here, and I'll be right back.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy. Tune in to Market Watchers Live at 12 p.m. Eastern Standard Time during the week of April 1st to April 5th to help us celebrate.
Okay, getting back into the markets here, one thing I wanted to talk about. So this was from Wednesday night, the CMT Association meeting, and they presented this U.S. Recession Risk dashboard. And what they did was basically put a fuel gauge on here, and then put some sliders and talked about what it would take for the market to actually break into recession. And by their standards, we're still in the green zone and everything is fine. So one of the things they had was the yield curve, credit spreads, money supply. And, they view two of these as currently stable, but inversion in the yield curve, and we all know that's kind of close. We had more inversion yesterday. I think we'll have more today. Anyway, as this tightens up, that one's an important one. Credit spreads are stable, so everybody was happy there, and money supply. So anyway, we can plot a couple of those on a graph. Then we've got wage growth, and wage growth continues, but you can see that they're a little bit concerned here. And commodities, stable pricing, and I would say stable but very low. They don't have it as very unfavorable pricing yet, but a lot of the ag components and stuff have been dropping for years. Housing permits, stable. I have a chart about that we're going to cover off. Jobless claims, retail sales, and sentiment. So again, they've created this dashboard, and the dashboard actually works pretty good. One of the things is I'll call it, they've got 5 different levels on this. And what happens is when you start to change the levels, you can change the fuel gauge. So let's just say I change the trucking to contraction. You can see it approaches a little bit, and I can say sharp slowdown in new orders or profit margins. And anyway, you can go and play on this. And the way to do it is to go to the Legg Mason website, and then at the very bottom, they have a, let's see if it's down here, they have a thing called Anatomy of a Recession, and you can go in here and get there. So anyway, just like Mason homepage. But this is the recession risk indicators all laid out on a graph, and this is why they think that everything is still okay. So as an example, one of the things in trucking shipments, and from that previous page, if you went to trucking shipments and you highlighted it, it said, sees a fall in truck shipments of greater than 5% is a strong indicator of recession. Cool. Well, we can go to our trucking graph and we can look and say, what's going on in trucking? Well, it's currently below the 40-week moving average and rolling over. It's making a series of lower highs and lower lows at this point. It made a high 4 or 5 weeks ago, and trucking is rolling over. I don't like it when the PPO rolls over below zero. That is a big thing for me. And what we see here back in 2007 is the PPO was down low. They had the rally into early 2008 and then fell. In the meantime, once these trend lines broke, in most cases, that was a pretty significant issue. In 2015, the oil patch slowed down meaningfully, and a lot of trucking takes place to take steel to the middle of nowhere, or move steel parts around, automation systems, all that kind of stuff. So as an industry, the oil patch, when it's rolling, can really use a lot of trucking. Rail doesn't really help them a whole bunch. It doesn't take it to the far off corners where they need it. So a lot of the end delivery systems are not to big city centers, they're to the outposts. And with that, I think the oil patch follows or creates problems in the trucking industry as well. Looking down here back in 2007, we saw the market break and then roll over. And the other thing to watch for was we started to see trucking underperform, and that was kind of a clue that things were changing. And down here in 2014, we got into this period in here, 2015. Well, now we've rolled over and we're starting to make new 52-week lows in relative strength performance for the trucking. I don't think trucking is the be-all and end-all. I actually think the railroads are a better indicator of the economic activity, and this chart is still holding up quite well. It's briefly been trying to take out this prior high, and one of the things we see here obviously is 4 or 5 weeks of sideways consternation. Hasn't really been able to break out. Down here on this chart, you can see that in 2007, 2008, when rail started to underperform, that was important. In 2011, that also marked a place where the stock market had trouble, but it wasn't a recession. 2014, rail started to underperform. And so over the last couple of shows, I've been talking about the rails, and I think the rails are actually, in my opinion, more important than the trucking. So the economists have picked up trucking as an important one, but I think trucking is part of it, not all of it. And again, I'm just using my charts to guide me. Now, we have housing permits and retail sales on the StockCharts website. So let's just go look at some of those. And as an example, I don't know, this chart gives me a little consternation in that we're starting to break below this moving average. And here I've just picked a 30-week moving average, in general riding up. And then when it rolls over, that's a bit of a problem. Well, we made new 12-month lows not too long ago. And what you see here is we had this kind of PPO wandering sideways for 4 years, and now it's starting to drop. It was actually probably one of the better clues that things were happening when this PPO started to make new 12-month lows in 08 and 09. And in 87, when the stock market dropped in the fall, this indicator had already started dropping. So there's a whole bunch of clues that we can use. And I think the PPO is one of the better clues to help us through this. And anyway, this big drop here suggests to me that housing's in more trouble than they give it credit for. So they still have housing permits as stable. I would put these right over here on the far right-hand side. Now I've moved some of these back. So I don't think ISM orders are in a problem state yet. But when we go through and look at all these, I would leave this trucking over here because it's below the 40-week moving average. And commodities, again, I don't think pricing is that favorable. I would say oil is one of the standouts right now on commodities. So anyway, as we go through these different things, I'll show you some of the other ones that I think are important. And here is the bond spreads. And again, this is these are end of day. That's what EOD means on these charts. And so with this end of day, you know, I got two things I could have done here and just boost this up. What you see here is right now the 3-month in pink is above 4 of these. So over here, it's above the 1, 2, 3, and 5 year. So those have all inverted. And what we're watching closely is the 10-year inverting to the 2-year, or some people watch the 3-month. In this particular case, the Clearbridge group watches the 3-month, I think it is. Anyway, so yeah, they're comparing the 10-year to the 3-month. So I would just say that that's, if it's not there, it's pretty much going to be there by tonight or early next week. So you can start sliding these things over. I'm using the charts. They're using the actual data, a different method of the data, but I'm using things like this momentum drop here to suggest to me that things are broken. And here's housing starts, and this chart's about to go negative. In 06, it was going negative. So these things start to worry me, or start to suggest to me that we have bigger fish to fry out here. One of the things I was looking at was wage and clerical workers, and this chart, you know, is such a linear chart, it doesn't really show much data. But the one thing that can help us is the PPO. And when the momentum is rolled over, at least it's a place to be cautious. So here in 08, the momentum rolled over. 2011 to 14, we had a downslide. Wasn't very helpful. The stock market didn't fall until 2014. But again, we also had quantitative easing where we were pedal to the metal with unlimited QE, it was called at the time. So we've rolled over and we're below our trend line right now, but it's bouncing back up. So I would just say that the wage inflation is trying to show up, and we'll see if it can continue. Industrial production, this one still looks very strong to me. So it's up in the top right-hand corner. It did roll over in December, and it bounced up in January and February. What do we have here? Yeah, Feb 1 data. So this one still looks okay. And just as we work through these charts, one of the things I like to watch is the banks, and I think I've mentioned this a few times. I'm not happy, and I don't like to see this roll over. And one of the conditions that they were bullish on the U.S. economy was that 2.7 trillion was going to be repatriated to the U.S. My question on that is, okay, and what happens when you take 2.7 trillion out of, I'll call it European banks, but foreign banks, and they have a 20 or 30 ratio on those loans. So now all of a sudden, the bank has a lot less equity for a lot of the loans they have lent out. And that 2.7 repatriating to the US, I think, places an extreme level of stress on the European banking system, or I'll call it the global banking system, to when you repatriate all of that money. So anyway, that's one of the things I'm watching. And again, this chart is the 40-week moving average. And look at the price action we're getting on this bank index. This is, I would say, a significant bar. It's coming down to pretty much where it was from early January. And literally, if that doesn't look like unloading to you, that's what it looks like to me. So I don't think it's good to watch the banks start to make new relative strength lows. We saw that here. We saw it in 2014-15. We saw it in 98-99. Actually rose once the recession started, which was interesting. The banks were performing better. That's probably because the tech stocks were falling. I'm just going to cover the broker dealers at the same point in time here. But the broker dealers rolling over under zero, I think that's a concern. I mentioned it. They're making new relative strength lows going back almost 2 years, and they're having a bad candle today as well. Some would say that's caused by the Fed. I would say the Fed's following the data, and so are the broker dealers. M2 money supply, this one doesn't look like a problem to me. I made the data invisible because it was just a sharp graph up, but I was watching the PPO to see if it would help us. I can't really find any way to use this data. The M2 money supply didn't seem to have any correlation for me. University of Michigan sentiment, this one is still holding above this trend line, so that's good. But look at the PPO. If it was about to go to below zero, I think that would be a problem. So I will try to put together some sort of a spreadsheet and start to show all of this information on a little checklist like they created, which I thought was actually very well done. And then maybe try to use the PPO on all of my indicators to get that. So here's unemployment, and I think we can all see this trend has been straight up. We briefly had a dip back here in early January, and we're holding above the 40-week moving average. You can see on most of these market tops when it rolled over, you know, maybe this line is a little too tight, but when it rolls over, that's probably something worthy of watching. But seeing the PPO go negative for the first time in 8 or 9 years, I don't think that's that helpful. So using these different types of tools, I think, is valuable. And again, using the PPO is also important. The 10 versus 2, a lot of people talk about this as the mortgage spread for banks. And when we see this, you know, again, our low here was about 11 cents. Let's just pick a number. And today we're at 13 cents. And somebody said, well, it's not at new all-time lows. And I would say, yeah, well, it's rolling back over again. And we've seen this movie before. So that one doesn't look that comfortable to me. The semiconductors look great. They've been pushing up in the top right-hand corner, and the PPO, after coming below zero, is trying to hold up here. If it was to start to roll over right now, I'd be a little more worried. The small cap watch, I think this one's always important, but the Russell's stuck below its 40-week, and you can see in 2014-15, that was a problem. In 2007 and 8, that was a problem. In 2001 and 2, that was a problem. So watching where the Russell is helps us see, at least when the market is migrated to the large caps. And, you know, we're starting to break down to new near 10-year lows on Russell relative strength. So I think that's also an important component for us to be aware of. Just before we wrap up here, here's the Dow Jones Global World Index. And again, when it's below the 40-week moving average, I think that's important. It is barely above, holding above. We've got a bit of a weak candle this week to kind of finish it off. But again, we've been below zero. We're bouncing back up. And I would say if we roll over here, this is an important distinction for us, that it's getting weaker. And again, just watching these big curves for the global index can be helpful to help set up the U.S. And again, the U.S. is one of the strongest markets in the world, usually the strongest, which would suggest to me that problems, well, some of them may start here. I think when your customers are all in trouble, it starts to make for bigger trouble for the U.S. market. Lastly, I'm going to end on the U.S. autos. And what's really interesting is how this thing has done nothing for, call it 15 years, with the exception of the downtrend when they almost all went broke. Anyway, this chart looks very close to making new lows. It's below the 40-week moving average. PPO rolling over below zero. I'd stay away from the autos. Anyway, hopefully you enjoyed that recession watch. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. Thank you. Bye-bye.